What just happened in the latest wave of institutional moves is not just another quarterly filing. It's a quiet divergence in how the smartest money on the planet is positioning for the next phase of the AI and platform economy. The most recent 13F disclosures for Q1 2026 reveal more than portfolio tweaks. They expose a split in conviction among the titans of finance, with some doubling down on cloud and AI infrastructure, while others pivot into unexpected sectors like airlines and mobility platforms. The real story isn't just what was bought or sold. It's why these Wall Street elite stocks are being reshuffled in such contrasting ways, and what that means for where capital could flow next. The filings, which reflect positions as of March 31, 2026, show that Pershing Square, led by Bill Ackman, made a decisive shift, initiating a fresh position in Microsoft while simultaneously exiting its entire stake in Alphabet. Meanwhile, Berkshire Hathaway ramped up its Alphabet holdings from 18 million to 58 million shares, a position now valued at $16.6 billion. These moves are confirmed through mandatory 13F disclosures, which offer a standardized, regulatory-mandated window into institutional portfolios as they stood at quarter end. While not real-time, these filings represent the most reliable public record of where elite capital was deployed entering mid-2026. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. This isn't random noise. It's a signal of deep disagreement over which AI infrastructure stocks offer the best risk-reward balance. Microsoft's stock accumulation by Pershing Square aligns with a view that enterprise adoption of AI tools is accelerating faster than expected. Ackman's move suggests a belief that Microsoft's integration of AI across Azure, Copilot, and enterprise tools offers a clearer near-term path to monetization than Alphabet's broader, more fragmented ecosystem. Meanwhile, Berkshire's massive bet on Alphabet reflects a conviction that dominant market positions in search and digital advertising, combined with growing cloud momentum, will continue to drive outsized returns. These opposing strategies reveal fundamentally different views on how AI value will be captured, through enterprise productivity or consumer-scale platforms. But the surprises don't stop there. Berkshire also made a bold return to airlines, establishing a new Delta Airlines stake worth between $2.65 billion and $3 billion. This is significant because Buffett had famously exited airline stocks after the pandemic, calling them structurally unattractive. Now, he's back in, suggesting a reassessment of the sector's recovery trajectory despite ongoing macroeconomic headwinds and high fuel costs. This Delta Airlines stake could signal a broader appetite for cyclical recovery plays, or it could be a highly concentrated bet on management execution and cost discipline. Either way, it adds a new layer to the puzzle of where the smart money is looking beyond pure tech. Amazon institutional interest remains strong, but the pattern is nuanced. Appaloosa Management, run by David Tepper, bought 2.1 million Amazon shares, making it a top holding worth around $900 million. Pershing Square also increased its Amazon stake by 19%. Yet, at the same time, Berkshire reduced its position. This split tells us that while Amazon is still seen as a core player in e-commerce and cloud, not all elite investors agree on its valuation or growth trajectory. The continued inflows from Tepper and Ackman, however, reinforce Amazon's status as a key battleground among Wall Street elite stocks. Uber investment trends also drew attention. Appaloosa expanded its position by roughly 4.5 million shares, bringing its total to about $455 million, while Pershing Square maintained a substantial holding. Uber's appeal lies in its platform-based business model, combining ride-sharing, food delivery, and emerging advertising revenue, all with improving profitability. It's not a pure tech stock, but it's increasingly treated like one by institutional investors who value scalable, asset-light models. This sustained conviction in platform-based business models suggests that the framework of digital ecosystems extends well beyond Silicon Valley's core. What ties these moves together is a focus on durability, cash flow, and structural advantage. The elite investor portfolio shifts seen in Q1 2026 aren't chasing fads. They're reinforcing positions in companies with pricing power, network effects, and clear paths to AI integration. The 13F filings 2026 collectively paint a picture of capital concentrating in businesses that can weather uncertainty while capturing long-term trends. Still, a major caveat remains. These filings are backward-looking. They show where money was in March, not where it is now. Market conditions, valuations, and macro risks have shifted since then. The real test will be whether these positions hold or evolve in the next quarter's disclosures. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next signal to watch is whether other major funds follow Ackman into Microsoft or echo Buffett's bet on Alphabet and Delta. Until then, the moves stand as a powerful read on how the most influential minds in finance are navigating the AI era. And for viewers tracking where the smartest capital flows, these Wall Street elite stocks offer one of the clearest maps available.